Today, I will teach you why it's utterly important for your retirement planning to start investing and saving as soon as possible. Even if you can only set aside small amounts at this time, you should start today. If you don't have any money left at the end of the month, then you should take this as an opportunity to either increase your income or, since this is often not possible, cut back on your spending. Almost everyone has some saving potential. You should regularly check your contracts, insurances, and subscriptions, for example. Everyone should also put their shopping habits to the test. Often people spend too much on unnecessary and expensive things than they realize. So keeping a journal of purchases can make you aware of this overspending. If you want to know more about healthy financial habits, I recommend watching this video of mine. Let's return back to the main topic. The main reason to start saving and investing today is because of compounding interest. Compounding interest simply means that the interest associated with a bank account, loan, or investment increases exponentially rather than linearly over time. Compound interest is the interest on savings calculated on both the initial principal and the accumulated interest from previous periods. Compounding multiplies money at an accelerated rate, and the greater the number of compounding periods, the greater the compounding interest will be. This is a graph from Wikipedia, which shows the power of compounding interest. Let's say you want to retire at 65 years and you start saving at 45. You cut off the most important part of this curve, the one where the exponentiality really comes into play and the interest is snowballing into great riches. If, on the other hand, you start making provisions for your retirement at the age of 25, you will enjoy the full benefits of exponential growth. That's why I say you need to start as early as possible. There is also another case. People who earn enough but do not care that their capital works for them. These people often say about themselves that they do not understand investing and do not want to lose money. Therefore, their money rots in a salary account that earns no or very little interest. What people who act this way do not understand is that they lose a lot of money when they act this way. On the one hand, they do not receive the historically generous compensation that the stock market has generated on average. Historically, that has been about 10% per year. This is only opportunity cost, meaning cost of an alternative use. On the other hand, you also have real cost. The devaluation is also working against you. The goods and services tend to increase in price over time. This is called inflation. Inflation is an increase in the general price level of goods and services in an economy over time. Money becomes worthless and less. $1 in 10 years will buy far less food than $1 today, especially if governments don't get a grip on the current rampant inflation soon. We used to have very low inflation, but it recently spiked due to high public debt and excessive money printing by central banks. Assuming an inflation of 3% per year, $100 today would only be worth $97 next year. In 10 years, the $100 bill would only buy goods and services worth $74. In 50 years, buying power shrinks to $22. In 100 years, it's less than $5. Therefore, if you do not start saving and investing in time, you will not only lose the best part of the compounding interest, a lot of gains lost, but inflation will eat away on your purchasing power too. Investing is not even difficult. On the contrary, It is easy and everyone should manage their own finances. Because only you know perfectly about your own preferences. Moreover, financial advisors often do not act in your best interest. They will usually try to maximize their own income and not recommend the best investments to their clients. They will usually recommend the product that will generate the most commissions. These are usually the worst options from the investor's point of view. With the passive investing approach, following a strict buy and hold strategy while minimizing costs, the past has shown that investors will outperform the majority of other speculators and institutional investors too. In addition, this approach is both intuitive and time saving. I believe that anyone can increase their wealth in this way. In the simplest case, all you need is a broadly, at best worldwide diversified index fund or ETF, which you more or less buy and forget about for many years, meaning you buy and hold and downsell until retirement. Market fluctuations are completely ignored. This is a bit oversimplified. You should set up an automatic monthly contribution to the chosen product and invest parts of your income without trying to time the market or do any stock picking at all. In the end, time in the market beats timing the market. Even many of the most successful investors of all time, such as Warren Buffett, for example, admit that it is almost impossible to time the market. So don't even waste time, energy, and money trying. Watch this video to learn more about the passive investing approach. Another very important note: if you are in debt at the moment, or be in debt and at the same time maintaining an investment portfolio, then it makes sense in most cases to pay off the debt first before starting to invest. This is especially true for expensive consumer and credit card debt. If your credit card company, for example, charges 16% per year, this is a guaranteed return of 16% which no other investment can beat on average. Thanks for watching. Don't forget to like, subscribe and share. Watch this video next to learn which financial instruments are sensible investments and which are not.